a lot of the trends that are sort of driving the world we live in at large are exponential. And the human mind doesn't do a really good job of understanding exponentials. And that's why my former partner, Chris Martenson, came up with this analogy about the magic eyedropper in the stadium. And so basically he says, look, pick the stadium of your choice. We usually use Yankee Stadium because we both were from New England and we're Boston Red Sox fans. So imagine somebody takes a magic eyedropper and walks down to the pitcher's mound and squeezes out a single drop of water right there on the pitcher's mound. And that drop of water doubles in volume every minute. So minute 1, it's 1 drop in size. Minute 2, it's 2 drops in size. Minute 3, it's 4 drops in size. Minute 4, it's 8 drops in size, right? So the question is if you got handcuffed to the topmost bleacher seat in the stadium, how long would you have to escape your handcuffs before the stadium was underwater? And, most people will say, I don't know, a year, months. The answer is very surprising. The answer is 45 minutes, much less time than you think. And that's just because when it doubles, each doubling is bigger than all the increases that came before it. But the really important question is at what point is the park only 3% filled? So like the infield is just covered in like a foot of water, and you can now begin to see, oh, this thing is starting to fill up. What time does that happen? And that happens at minute like 40. So basically, by the time you see there's a problem, the stadium's filled just a couple of minutes later, right? By the time you see the issue, it's way too late to avoid it. Your only choices at this point in time are just to sort of manage the impact. And so I think that's very much what you guys are picking up here, where it feels like we're that far along in a lot of these exponential trends that if you're sitting there hoping, oh, well, maybe somebody's going to come up with a solution and we can avoid this problem that I'm seeing, in a lot of cases, that's not going to happen. And you're really just wasting precious time with false hope. What you should be doing is saying, okay, it looks like this is going to happen. I need to figure out how I'm going to reduce my vulnerability to its full force arrival. That's the right way to use the time we have left here. Right now, I think is getting pretty late in the game, especially if you live in parts of the world that are really suffering right now under just crushing inflation. I mean, I don't think anybody in Europe, for example, could have ever forecasted a year ago that they would be paying what they're paying right now for energy. Yeah. Collapse happens from the outside in, right? It's the weaker players that fall first. And then those are dominoes that topple over bigger dominoes. And then it all begins to progress toward the center. And yes, we live here in our fishbowl, our goldfish bowl here in the US. We do have a lot of advantages that a lot of other countries don't have. And so we're likely not going to be the first one to fall. We're probably likely going to be the last one. But to find out where we are in the story, we want to look out at the periphery and see how it's doing. And the very extreme ends of the periphery are not doing well at all, right? You've got a place like Sri Lanka that's basically, gone into full collapse, right? Yeah. I don't know if you saw the videos of the people a few months ago storming the presidential palace. You got to remember, like we saw a preview of this happen during the Arab Spring, right? It was sort of put off in the media as, oh, look, this is democracy in action. These are people that are rising up against, dictators and whatnot. That really wasn't the primary motivation for the Arab Spring. It was that they experienced sudden and extreme inflation in those countries, and all of a sudden people couldn't feed their families or keep them warm. And when you get to that point, you really don't have any other option but to throw out whoever's in power, because whatever they're doing just isn't working for you, right? You're beginning to drown. And so that's what happened in Sri Lanka. And, that's beginning to happen with greater frequency elsewhere in the world. And Europe isn't in that case yet, but it's certainly a lot closer to that destination, sadly, than it was a year ago. We are beginning to see, as things, as you go along an exponential curve, things happen faster and faster, right? And so we're beginning to see more of these really big things that we just really couldn't have ever expected would happen, right? oh, the Saudis are maybe, beginning to reject the petrodollar. Oh, England's bond market almost blew up. And to your point, Robert, somebody just sabotaged the Nord Stream pipeline. I don't think I don't think anybody debates that this was an act of sabotage. Now you can talk, a lot of people are saying, pointing fingers in different directions. We're seeing more of these things that nobody could have seen coming, more of these sort of black swans. And of course, the more they are and the faster they happen, the more the odds of something really systemic breaking and something really bad happening obviously increases. So let's start with explaining what bonds are, and then we'll get into are they a good place to be now or not? Because the answer's it's a little bit nuanced, and it's a sense of like something that might have that might not be something good to be in the long term, might be something good to be in the near term, and I can explain why a little bit later in the conversation. But let's start with sort of what is a bond, right? Let me contrast it with what's an equity or a stock, because I think people understand that really easily, right? A stock is basically just a share of ownership in something, right? I can go buy a share of Apple. It's clear I don't own all of Apple Corporation, but I own, I don't know how many shares Apple has outstanding, but let's assume it's 100 million. I have a 100 millionth claim in terms of the earnings that Apple owns and the assets that it has, right? I'm a part-time shareholder or fractional shareholder in this company. A bond is not ownership. A bond is an IOU, essentially. Where you give your money to somebody and they say, okay, I'm going to pay you back, but for the risk that you're taking by giving me your money, I'm going to pay you some interest as well along the way. So it's basically just a contract, and it's just math. Bonds tend to be a little bit easier to deal with, because when you're dealing with a stock, you have to take into account all sorts of things. Okay, what's the potential of this company to earn money over time, and what do I discount those earning streams back at, and what's their competition doing, and maybe they're going to take over their category, or maybe they're going to be outcompeted. Bonds, it's really just much more, okay, what's the math of this contract I've entered into with you, and then you have to factor in a little bit of default risk, right? Which is, okay, what's the likelihood this person's actually going to be able to deliver on what they're telling me they're going to do, right? So if you are borrowing from the US Treasury, that is considered, and we can debate this in a minute, but that's considered to be basically about the safest type of debt that you can take on. And one of the reasons why it's so safe is, first, the US is the biggest, most stable player out there on a relative basis, but also we have a printing press, so if we really get in trouble, the Federal Reserve can basically print up the money to give to the Treasury to make sure that they pay you back. So, you are going to get paid back, at least nominally, meaning if I give you $100, it's a high likelihood you're going to give me $100 back. Now, if they had to print those $100 to pay me back, then maybe those $100 are devalued a bit by inflation. But again, borrowing from the US Treasury, relative basis, pretty darn safe. Borrowing from a company that's got what's called high yield debt, which is sort of the fancy way to say junk debt. This is a company that maybe isn't profitable, maybe already has a lot of debt on its balance sheet. Its prospects don't look very good. First off, that debt is going to come you're going to demand a higher yield to borrow that debt, right? Or to buy that debt, because you don't trust their ability to pay you back as much. And so that's a riskier debt. So there's sort of a spectrum of bonds that are out there. Those that are considered to be very safe, or those that are considered to be very speculative. And basically it's the yield on the bonds that differ between the two. A more speculative bond should likely offer you a higher yield because that's making up for the higher risk. You may hear on the news people talk about an inverted yield curve.
Yes.
And that is exactly what you just discussed there, Kim, which is shorter term bond yields are higher than longer term bond yields. And first, you would expect higher term bond yields to be higher to compensate you for the risk of getting paid back over a longer period of time, right? If I gave you if you borrowed money from me and we're going to give it back to me tomorrow, well, my duration risk is pretty low, right? I'm going to get it back tomorrow. I'm not going to charge you all that much to borrow it overnight. If you want to borrow it for 30 years, I'm going to say, yeah, Kim, you're going to have to pay me more money because I'm basically giving you my money for a much longer period of time. When people when the bond market gets nervous about where things are headed, and it thinks that something bad might happen in the relatively near term, that then pushes up those short-term interest rates. And so it's basically the bond market telling you, I think in 30 years, things are going to be back to normal. I think we're going to be okay in the long run, but I think we're going to have some rough times in the very near future. And that's why I'm going to demand a higher interest rate in the short term. Probably many factors for that inversion, but two important things about it. One, an inverted yield curve is one of the most dependable signals we have of approaching recession. Right. So, if you see an inverted yield curve like we have today, you should say, all right, look, I gotta get prepared that we may be entering a pretty, material recession in the not too distant future, because whenever we've seen this before, it's happened, right? And right now, as you guys know well, we've got a big inflation problem around the world, but certainly in this country. Most central banks, definitely the Fed, are hiking rates right now to get inflation under control.